When we do these videos each week, the first thing we have to decide is on a title. So let's start with last week's title. We will continue to give the bulls the benefit of the doubt until bearish evidence surfaces. I believe this week we should just stamp continued on that title on January 18th. Did that work last week? Yes, it did. Fortunately for us, the S&P 500, we were long, was up 0.095%. The bullets from last week's video still apply. We've added one new bullet. Quickly, the DeMark counts, they're still there. They're still concerning. Last week we wondered if we were in a hesitation or a bearish flip. Bonds outperformed emerging markets. With Friday's close, I would have to say that we would have to give hesitation the benefit of the doubt based upon what we know over a bearish flip, but we'll keep an open mind. The divergences on the S&P 500 weekly that we discussed last week are still there, but they did improve. That's why this is green. It doesn't look as bad. Adding to the concerning list is our models, and we'll cover what tired bull territory means when we look at some numbers. Our models are still in bullish territory, which basically tells you that the technicals on multiple time frames remain bullish. Intermarket trends, risk off, risk on, still good. Last week we talked about weekly MACD crosses. That helped us this week. Stock market was up. Those were bullish weekly crosses we discussed in last week's video. The moving averages we discussed as being bullish last week helped us make money. There's no question the markets are overbought or overextended here, but that does not mean that they can't move higher. And we'll put some numbers around that when we look at our models. Have to keep in mind that the weather always looks perfect when it's perfect, and at some point it has to change. Our job is to keep an open mind when the market looks good technically and understand that at some point it'll look nearly perfect, and we have to pick up the subtle changes that take place so we can lock in profits before we move over here and don't have an umbrella. In this video, we'll look at support for the S&P 500. We'll review several bullish charts. We'll look at our models and what I call take action tops. Friday's session, the market looked very vulnerable in the morning and until roughly midday. In fact, we took some profits off the table and reduced risk. The afternoon and the close was extremely bullish. And typically, when the market does not do what you expect it to do, meaning the market looked very vulnerable on Friday and looked like more weakness was ahead, that's not what happened. You really need to pay attention to that, and that leans bullish still going into next week. We have to make this market prove to us that it's rolling over. An example would be on a daily chart. If you make a lower low, that's a good start. We have not done that yet. You can also look at 5-minute charts, 10-minute charts, 30-minute charts. And if you start to see the 1, 2, 3 trend change, the three things that need to happen on a trend change, it has to happen on a 1-minute chart first, and then a 5-minute, then a 10-minute, then a 15-minute, then a 30, then a 60, then a daily. So if you start looking at shorter time frames, that can tip you off a little bit. You can also watch going forward in terms of making the market prove it to us. If bonds, your TLTs, your IEFs, your AGGs, your BNDs catch a bid, and credit spreads tell us to be careful, and the VIX turns around after what was a disastrous week last week if you own the VIX. These all can help us answer the question, has the market proved it to us? And as of Friday's close on the 18th, it has not proven to us that we should cover our longs. Let's set the stage for what we're looking at here. These are the CCM market models, the 80-20 correction index. This is our new and faster market risk model. This is the bull market sustainability index. We categorized, when we built these models, markets as being bullish, in a neutral zone, or in a bearish zone. we're looking at here is historical readings of what a market peak looks like. And the definition of a market peak in these models is, anecdotally, would I have wanted to do something with my portfolio with the benefit of hindsight? So typically that means that the pullback had to be in the 3 to 5% range minimum being 3%. If it was a 2% pullback, we just ignored it. We built these models. And typically the pullback would have to be longer than something like 3 sessions. So pullbacks that we would want to take defensive action of some kind. Here, this shows you the current reading as of Friday, January 18th on the 80-20 correction index. A typical peak where you would want to take action occurs, the median peak was at 70, so we're within the range of a higher probability of a reversal. Risk model, the median peaks at 93, we're at 94. Bull market sustainability index, the median peak is at 89, we closed Friday at 90. The composite, which is just a simple average of these three numbers, is 83 at a typical point where you would want to take some defensive action. We closed at 85 on Friday. Median tells you that half of the peaks occurred with a number higher than this. Half of them occurred with a number higher than 93. Half of them occurred with a number higher than 89, and so forth. So there's still room for this market to potentially run, but we are in an overbought condition, and any source of bad news on the earnings front or something negative out of Europe, or the highest probability probably comes from something negative relative to the debt ceiling negotiations in Washington, we could easily see a 3 to 5% pullback that could last anywhere from 3 to 10 trading sessions. In the real world, the 80-20 correction index has hit a level as high as 100. Risk model, 100. BMSI, 100. So again, there's some room to run. The highest composite reading that we've ever recorded is a 97. We closed Friday at 85. This is a daily chart of the S&P 500 index as of the close on Friday, January 13th, 2013. Since we believe and know that the market is extended, overbought, and potentially vulnerable to bad news over the next few weeks, it makes sense to get a good handle on support. If you prepare in advance and have a chart like this, if the market comes down into this region, it's much, much easier to remain invested and try to relax a little bit, which is exactly what we were able to do at the end of the year, which enabled us to capture these gains here. The market is in a trend channel. These are parallel lines. Channels tend to run with an upper channel and a lower channel. Here's your upper channel from here to here, your lower channel from here to here, and from here to here. We also have a sub channel, upper channel, lower channel here. Moral of the story, if the market comes down, there's potential support here at this channel. If that breaks, there's potential support here at this channel line, and if that doesn't hold, we could come all the way back down to the lower piece of the trend channel. And here, what we've looked at, this is a high here and a closing higher, these two numbers, 1474, 1465. In summary, here are the numbers that are shown here that could potentially be important and act as support, and these are ranges of possible support that we can all watch should we see weakness next week or in the following week. This is a daily chart of the S&P 500 index, again as of the close on January 18th. This shows closing prices only. You can see we have the concept of a head and shoulders, a left shoulder, here's your head, here's your right shoulder. This is an inverted head and shoulders pattern, which can be bullish. Here's your neckline. Things to consider here. Often a neckline is revisited after a breakout, so a move back to 1450, 1451-ish on the S&P 500 would not be surprising. We also have support here. This low on a closing basis is 1471. The reason why we're showing this potential head and shoulders or inverted head and shoulders pattern with a neckline here where I've got the cursor is it's a bullish pattern. This is your target. Here you extend this green line to the breakout point. That could take you 100 points roughly above this level here, or somewhere in the neighborhood of, let's say, 1545-ish, 1550-ish on the S&P 500 is within the realm of possibility based on this chart pattern. It's one possible scenario. The neckline here, you can make a case, comes all the way back to 1440. Again, necklines are often retested. So if we move back, 1440 might be a good entry point. If Friday was a high, and we really have no reason to believe that yet, from a Fibonacci retracement perspective, if I retrace the move from this November low here to the high on Friday, the 61.8% retracement level is around 1434 and change. Let's call it 1435, which also aligns with this 1440-ish number here. This has bullish implications if it actually plays out going forward, with possible support at 1440 or 1435-ish on the S&P 500 index daily. This is a daily chart of the NASDAQ Composite Index, or tech stocks, as of the close on Friday, January 18th. The quick point, this is a gap open, which is bullish. We've held the gap, which is a good sign. Tells us that if we see weakness, NASDAQ could see support somewhere in the 3075 range. This is an update on a weekly EFA ETF chart that we've looked at. Quick point, momentum here on a weekly chart, Williams percent R, still healthy, showing a little vulnerability here. Point of the exercise, we're above all of these trend lines, which is bullish. If we see some weakness, because we do have an extended market and extended DeMark counts even on EFA, support could come anywhere from these trend lines here. If I had to guess, I'd say the probability is low that EFA, given what we know today, would go back below this lower trend line here at 5450-ish on EFA. This is another chart we've shown in past videos. This is the New York Stock Exchange Composite Index. It's a weekly chart as of a close on January 18th. The point of the exercise, a very long-term trend line from October of 2007, has not only been violated in a bullish manner, this is a bullish breakout, but we also had a retest here, and now we've come back above it and made a higher high. It's very, very difficult to look at this chart as it sits now and say that it doesn't have bullish implications. A break of this trend line here would negate everything that I just said. If we move into this area here, that would become concerning. Momentum, still strong here. No red or yellow flags on this chart yet. This is a market breadth chart that we often tweet on Twitter or post on our blog, short takes, which you can find on our website. January 18th close last Friday. This tells you that market breadth is still strong. Very odd that you would see a significant pullback without this summation index line rolling over. You can see market breadth rolls over here, stock market rolls over soon thereafter. Summation shows some weakness, market shows some weakness. No red flags here yet. We'll be watching it next week. This is a 60-minute chart of the S&P 500. Quick point. This is midday on Friday the 18th. Market looked very vulnerable here. It held at a logical level. 2 points here. The market closed with a very bullish-looking candlestick. That shows buying power in the last hour of trading. Buying power last hour of trading led to higher highs. If you look at it from a momentum perspective on a 60-minute chart, come down to Williams percent R. This is a good sign when Williams percent R comes down but does not go into oversold territory as it did midday on Friday. Right now, this chart looks pretty healthy still. We'll keep an open mind next week. This is a 30-minute chart of the S&P 500, and you'll notice that we do our analysis in multiple time frames. I failed to mention on a previous daily S&P 500 chart that we are moving towards the top of one of these trend channels. So you can see here, if the market were to go much higher, maybe in the 1492 to 1500 and change range, that we could hit a level here where prices have been repelled in the past. You can also see markets can stay near these trend lines for some time. So it doesn't necessarily mean that you have to reverse, but we should keep an open mind as we move towards potentially the top of this trend channel here next week. Similar concept, just a different look. Another 60-minute chart. You can see here this trend line, this thin blue trend line, repelled prices here, 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 and here. It is just ahead again. However, I'll caveat it with that's a pretty bullish looking candlestick, and we still have that bullish Williams percent R momentum that we noted. So we'll just keep an open mind here when we reach this trend line, if we do, early next week. This is a long-term monthly horizontal resistance chart that we use and we've shown in videos sometime over the past 6 months to a year. Quick point. The market here in 2007, when we closed above 1440 with a strong looking candlestick, the market eventually made it all the way to 1540 here. Market was repelled. Nice looking candlestick closing above 1440. Market was repelled. Nice looking candlestick above 1440. Just says to keep an open mind about this market potentially moving much, much higher than we can envision from a rationality standpoint as of the close on Friday, January 18th. Understanding this is a small chart, we'll keep it consistent though. This is what we've posted on Short Takes, our blog recently. This is an updated version as of the close on the 18th. This is the S&P 500 risk on divided by the VIX risk off. As we described in the blog, resistance for the ratio, S&P 500 declined. S&P 500 daily down here. Resistance, market weakness. Resistance, market weakness. Resistance, market weakness. When the VIX just absolutely imploded on Friday, we broke out above this line. You can see we've gone basically straight up on this ratio, which means since late last year, if you've owned the VIX instead of the S&P 500, this has been a very, very painful experience. This breakout, if it holds, is bullish for risk on. If you know technical analysis, sometimes you can see we broke above this blue trend line here and reversed. Sometimes breakouts are really fake outs and the market reverses on you. Right now, this is unequivocally bullish the way that it looks now. We can't assume that we won't get a reversal. This is just another look at the same concept, same chart. Clearly, you can see there's a breakout here on Friday, S&P 500 divided by VIX daily. Taking it a step further, this is S&P 500 divided by VIX monthly. I hesitate to show monthly charts in the middle of a month because this breakout could easily come back down in the next 2 weeks or so. Point. Here is 2011. This is all of your concerns about Europe and the debt ceiling and the fiscal cliff in the United States. Resistance, resistance, resistance. Didn't even make it. Here we have a clear breakout, which as this chart sits now is telling you, right, wrong, or indifferent, The market believes that the immediate concerns in Europe have been alleviated, at least for now, and the immediate concerns related to the fiscal cliff and the debt ceiling have been alleviated as it sits now. Again, that may be right, wrong, or indifferent. Doesn't matter what we think or what we believe. It matters what the market believes, because the market sets prices. As this chart sits now, it's bullish for stocks, bearish for risk-off assets like the VIX and conservative bonds. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.